Hello and welcome everyone to our July RBA and economic update. I'm here with Evan Lucas, I'm Ben Kingsley, and we're going to spend the next hour or so with you in unpacking, maybe even a little bit longer. We're obviously 20 minutes before the RBA update, and really looking forward to what we've got to talk about today, Evan.
Yeah, because today, Ben, the difference between normal ones of these and today is that we're going to spend a lot of time on us here in Australia for good reason. I mean, the 6 weeks rather than the monthly updates that we're now going through means that the data skips between meetings.
It does. There's a lot of
stuff that we're
recalibration that we have to do.
Okay, because I mean, we were talking about before we came on, for instance, and let's get into that in a minute. But there is data that's happened in Europe that happened on the same day that we last spoke to you. But the reason July is going to be so interesting is that we think, obviously we're 20 minutes away, but we think the RBA is going to do something that's slightly out of character for them over the last 12 months, which is talk about being completely data dependent, being very, very conservative, waiting pretty much for all the quarterly information before they move. That looks like being broken today. So yes, that is why we're going to spend a lot of time talking about us rather than talking about what's been happening overseas, which has been an absolute, paramount part of this program.
There's been a 12-day war and a few other things that have also gone on. So let's jump in. Let's start to look at the Australian market. So what I've done is there's a couple of key themes that we wanted to look at before the call. Now, remember the last call was in May, and we saw between that 12-day war that we had with Israel having affirmative action against Iran, and then the US coming in and also obviously bombing all of their nuclear facilities to try and ensure that Iran never got nuclear weapons. Then we've obviously seen the GDP data, which came in quite sluggish for the Australian market. So outside of the government spending, which is propping it up, there's a bit of a story there. And I think that's got to be weighing on the board's mind in terms of where is that next phase of growth coming? Because at the moment, you've got to remember, we've got the brakes on. We've got the brakes on in terms of that, and that leads into inflation.
Yeah, and it also needs to be pointed out, even with what we think will happen in 20 minutes, the brake will still be on. And I think that's also part of it, because what we saw in June's obviously the end of the financial year, and that is something also that we'll talk about over the coming period, not just in this meeting, but in the next one as well, is inflation. Now, the interesting thing about it is that sometimes we probably don't explain this well enough. When we look at the inflation read, it's a rolling 12-month average. So, inflation's growing at the moment on trim mean at 2.4%, according to the monthly figure.
Yes.
That still means that it's growing, but obviously not at the same rate. But also it means that the data constantly changes. And this time last year was when we started to really see the slowdown in inflation. So the roll-off will be quick. And therefore there is some data, and we'll come to that in a minute, that not just that inflation is going to be in the middle of the band, which it's slightly below now, but it could even go below it. I think the next thing to also talk about, and we'll talk about this quite a lot, is business and productivity, etc. Because the other data that came out during the last 6 weeks is, private capital expenditure numbers. They were really, really anemic. So much so that what I think all of this, and this, why Ben's got sluggish economic growth there as a number one thing, is operational expenditure and future CapEx expenditure are clearly really diverging. And it's operating at today, the future, that will happen. And you can see that in terms of the intentions and the way businesses are spending. And for me, that's my real concern, is that businesses are like, I just want to survive.
Well, yeah, I mean, look, we've seen some of the biggest numbers of business collapses. So it's finally taken its toll. We're seeing a lot of businesses go into liquidation and insolvency. And so we're seeing...
Just on that point, 2025 has already beaten the record that was last year. And we are, as we speak today, it is June 8th. It's already ahead of that, and there is still, well enough 6 months to go in this calendar year. So that is the real issue, is that insolvencies are already at records, and we're only halfway year through. And last year was bad. There was 1,100 and something.
There was a lot of businesses that tried to hold on, but now it's actually catching up. And of course, some of that is off the back of some of that government spending has peaked. And obviously we're not seeing that, and we're just not seeing the consumer basically out there spending as well.
And I need to also be fair on that as well, because I agree with you. The other one they're pointing out is that there's a lot of micro businesses that were started during COVID that have been rolled up because it just makes no sense for them to do the operating costs. So I get that. But, and it is a but, the overall trend is still there, right? The trend is the main thing, is that the business world is telling us that at the moment they're just not, they're on strike. And even the government now is realizing that they need to get involved to help business.
Well, of course, the other thing there is, don't start me on the Victorian market in terms of the confidence that we have in terms of our current labour market and also our debt levels. But here's where we want to start. We want to sort of filter in from inflation. We think this is going to be, what are we now? We're 14 minutes away from the announcement at 2:30. So we're going to spend a bit of time in talking about the inflation data, which has turned the dial a little bit. So we think about what we were talking about at the start of the year, and I know we had some concerns around services inflation in terms of what that was looking at. So here's what we've done this month. We've actually expanded out the data set for a 3-year period. So you can start to see where we were in that sort of inflation cycle in those 7s and peaking over 8, and now where we've come back to. So let's take a look at what the ABS data released on the monthly consumer price index. It increased by 2.1% in May, easing from 2.4% in the previous 3 months, and marking the lowest rate since October of 2024. This reading came in below expectations of a reading of 2.3 rise, but remained within the central bank's target range of 2 to 3%. Food and non-alcoholic beverages rose at the slowest pace in 5 months, 2.9 versus 3.1 in April, amid a significant slowdown in fruit and vegetable prices as well. Inflation also moderated for housing, 2% versus 2.2, and for recreation and culture, 1.4 versus 3.6. In contrast, inflation accelerated in alcohol and tobacco, 5.9% versus 5.7, and clothing, 1.3% versus 0.8 of 1%, whilst remaining steady for health, 4.4, and education at 5.7. Meanwhile, deflation in the transport sector softened, negative 2.5 versus negative 3.2, and the all-important annual trimmed mean inflation slowed to 2.4 from 2.8 in the prior month, making it the lowest since November of 2021. Now, of course, remember, trim mean excludes those volatile items such as travel, energy, petrol, those types of inputs as part of that story. So we're now seeing the CPI, rose to 2.7, down slightly from 2.8 in April. And this is where we wanted to go with this, Evan. Here's the trim mean data. So talk to us in relation to this particular slide.
So just understand that this has got the ABS data, but also, as you can see, the Melbourne Institute trim mean gauge. So this is them actually extrapolating out the data that Ben just read out before. So you will notice that it is low, and it's actually lower than what the trim mean figure is. But it is a very good indicator of future expectations around trim mean. And as the previous chart showed, and what Ben was showing, that you can see that downward decline and that flatlining figure basically since September 24. So you can now see we sort of have hit that baseline. And this is where the RBA has argued in the past at a higher level, but in the past, that inflation, that last 10%, as they refer to it, takes even more effort than the first 90%. But what this is also showing is that the roll-off and the speed of the roll-off of data points is actually going to rapidly increase the decrease in inflation. And that's what you can see.
The base effect.
And so the baseline effect is clearly there. You can see that through how the gauge looks.
Yeah.
What they're also telling you is that the RBA may have a slight problem in that it could see itself fall below target. So
definitely below their forecast.
Yeah. So the one to look at if you look at this chart and stay on it, have a look at between basically mid 2016 all the way through to pretty much the start of COVID, right? So 2020, the start of, you can see very flat in that green line, but what it's also showing you, it's below 2%. And there's always been this argument that the RBA during that period, which broke the record for the most amount of meetings unchanged, and I've talked about this before, but they were at the time saying the cash rate was at 1%. We need ammunition for the unseen event. Okay, they were right. COVID happened. But there's also an argument to suggest that they should have actually acted both up and down to stimulate, cutting rates to maybe half of 1% during 2017 in particular, and then bringing it back up. But they didn't do that either side. And we're sort of in the same period now because inflation on the way up, they rose rates, but some would argue maybe not as much. And now on the way down, are they too slow to act on the way down?
Well, the argument there is we never saw real wages growth during that time. And so potentially putting a little bit of extra money in the economy could have pushed wages up a little bit higher in terms of competition for talent. And
particularly during that period where
it was obviously pre-COVID where everything changed, but we just weren't solid.
And during pre-COVID, it was just this, there was almost this happy-go-lucky sort of thing. Oh, everything's okay.
Yeah.
Like, things weren't booming, but everything's okay.
They couldn't understand why they weren't getting wage growth.
And they were, they were also asking the question, like, you lead a horse to water. I mean, they were leading businesses to cheap funding. They were trying to stimulate, housing was doing reasonably well, but obviously not as it done in the last couple of years. Overall, things were just, I think the word almost is humming, to be polite. I think it's probably a good way of saying it. We're humming without buzzing, was doing enough. But and again, hindsight's a beautiful thing, and I get that.
Yeah.
But I think the same argument will probably be made about this period in 5 years' time, which is, did we err on the side of caution on the way up and on the way down?
I think we've also got to remember that we're on that really huge economic run.
Yeah.
I think, at the time we didn't think we'd have such a period of, no economic recessions or anything like that. So I think at the point, they were probably sort of saying, how fine-tuned are we?
Yeah.
And playing around with it.
There was stuff at the time. So, I mean, we'd gone through 2011 with the Euro crisis. 2015, from an Australian perspective, was also the year that all of the world had forecast China's eventual final hard landing. And that never came. And there was a lot of people sort of saying, this is the year, it's going to come. 2015, 16, there was some, flickers.
Yeah.
But it never eventuated, and sort of off we went. Anyway.
And so, look, off the back of those stronger than expected or better than expected inflation numbers, here's what we've seen in terms of market expectations around those interest rates and where we're potentially going. So it's pretty much a lay down misère that we're going to see some cut today.
Yeah.
The big question is it going to be a 25 basis point cut, or is it going to be a 50 basis points cut? Because what we do know from the minutes of the last meeting, that a 25 and a 50 basis points cut was discussed.
Yep.
So we saw the Governor Bullock move from what was maybe a hawkish position prior to that to some dovish comments in respect of basically what was going on. So we could be surprised today. We could be surprised with a 50 basis point cut, or maybe even an odd one, which is a 0.35, which just brings it back down to a really simple number to understand in terms of halves and whole numbers, as opposed to the current setup we've got here. So that's so we know something's coming. Like, we would be in shock. We'll fall off our chairs if there's not a rate cut today, but we'll see what happens. Here's what's coming in the future, Evan.
Yeah, and so the reason I wanted to use this chart was that it actually shows you the number of cuts of 25 basis points expected to June next year. So instead of looking at it in a different way, what this is telling you is that the market has 3.6 cuts baked in by this time next year.
So that's not 3.6% cut.
No.
That's just 3 times 25 basis points.
So that's 0.75
correct.
definite, with the fairly reasonable probability of a full 1% out from today. Now, that doesn't include the one that we expect to happen in the next 5 minutes, but it would mean that the cash rate would go from what it currently is, which is 3.85%, to 2.85% if the optimism is there, or more likely it will come to 3.1% with the probability of another 25 on top of it. And that's pretty big, because what I also want is you can see that it's actually realistically by February. I mean, that's what needs to be pointed out there as well, is that it's saying that that's going to happen by pretty much before the first meeting of next year. So that would be 3 more this year.
Well, remember, we've only got 8 meetings now throughout the course of the year. So effectively, we've got an August meeting, which if we're looking at the market expectations, it's around 85 to 90% probability of an August rate cut as well. Depends on what we get today. I mean, if we get a higher cut today, then probably that buys a little bit of time in terms of it. Then we've got meetings in September, October, November. And then we're done.
November,
December. My bad.
Yeah.
So ultimately, we've only got those extra 3 meetings after the August meeting to make those other moves. And so there's a lot of talk about another 2, possibly 3, and some even more dovish are saying 4.
Yeah. So with that in mind, don't forget, we are going to get at the end of this month, start of August, all of the quarterly data for the second part of this calendar year. And that will probably most likely lock in August.
Q2. Yep.
Therefore, September is probably the one that will miss out.
Yep.
With November, which is still somehow magically happens to perfectly be Melbourne Cup Day.
Yes.
Will be when we get the third quarter data for the calendar year as well through end of September through October. And that's the most likely one for the consensus view that there's 3, which includes the one that we're about to have in 4 minutes. What would be interesting is if in October, the quarterly data is really soft and it lines up December. And that would be the last meeting of the calendar year. The December meeting might be the 4th one. More likely, it will be get through Christmas, New Year, and the first meeting of calendar year 26.
Yep.
Which is what happened this year. They've got enough time to rewrite the narrative to explain, right, we're no longer break on and we're no longer neutral. We're now off to the accelerator pedal and trying to push in 2026.
Well, that's right. I mean, we waited for the Q1 inflation data and that before we moved. But obviously that was the April movement and the Feb in terms of that type of thing. Feb came off the back of a really poor December quarter spending pack program, so they knew
which
that
I put my hand up and caught me because I didn't think they would go, because the way they've been saying I had May locked in and then 3 for this calendar year.
Yeah,
I didn't think that they had with the communication February locked in, but February, as I said,
well, I was a little bullish on that.
You were bullish on that, and you won that. And the reason that was fascinating was because, again, that I think what's going to happen today is similar to that, in the fact that if you actually look at their communication, some, and particularly those that are more hawkish, are arguing they haven't laid the groundwork in the communication for today.
Yeah.
But the same argument was made in February. They hadn't made the communication, but as you well pointed out, in February was actually, the data for the end of last year was really poor,
really woeful.
And they were also looking at the roll-on data, which we just talked about with inflation, that hang on a minute, and we do need to catch the falling knife.
They do go to market these days more. They have their consultative data that they're also getting from industry, which we don't necessarily have the privilege of seeing or hearing those conversations around
business
liaison reports and so forth that they're having. And again, they took a different view than like the CBA. CBA has been very bullish in terms of several cuts for this year based off the back of their spending data patterns and other things that were happening in there as well. So it really is, again, with the May cut and obviously with this month-on-month inflation data surprising on the downside.
Yeah.
Because you've got to remember, Michelle Bullock at the start of the year was talking about this concept of, I'm not seeing what the market's seeing, and I'm thinking it's probably going to take a little bit longer to get inflation within the 2 to 3% bandwidth. And remember, she was saying her trigger point for her was going to be around 2.5, where she would start to really release that break off. Now, if they've got confidence now that through the base effect of some of those higher numbers dropping off, that the inflation read is actually going to be a little bit smarter, we're then potentially going to be in a position where you might see a few more of those rate cuts coming through. So
we've got 15 seconds. And you're right. So the other thing we've got to remember with that base effect and also with the data, it's retrospective.
Yes.
Right. So
it's lag data.
What the February data caught us out with was the fact that she's like, hang on a minute, we are behind because it's lag data, and we therefore need to make sure that we catch up. And that's what we're doing. And that's what we think with what we're about to do right this second.
Okay, let's see what we've got. We're waiting for the website to catch up. Effective 9 July.
They didn't move rates. They have not moved rates.
They have not moved the cash rate.
They have not moved the cash rate. So there you go. That is going to create quite a movement.
Wowee.
So they have gone against 88% of economists, 95% of the market pricing, and have held the cash rate at
You only get one of these. I reckon you get about one of these a decade.
Yeah.
You know, where this is coming in. At today's board meeting, the board decided to leave the cash rate target unchanged at 3.85%. Inflation has fallen substantially since the peak of 2022, as higher interest rates have been working to bring aggregate demand and supply closer towards balance. I'm still processing that.
Right.
In the March quarter, headline inflation, which has partly been affected by temporary cost of living relief, was all the midpoint of the target range, while trim mean inflation was at 2.9%. The baseline forecast for May was underlying inflation to continue to moderate to around the midpoint of 2 to 3%, with the cash rate assumed to follow a gradual easing path. While recent CPI indicators had suggested that the June quarter inflation is likely to be brought in line with forecast, they were at the margin slightly stronger than expected. With the cash rate 50 basis points lower than 5 months ago and wider economic conditions evolving broadly as expected, the board judged that it would wait for a little more information to confirm that inflation remains on track to reach 2.5% on a sustainable basis.
So scroll to the bottom, because the other thing that's happened for the first time in this meeting is we get to know the votes and who voted for what. It was done at 6-3. So 6 voted in holding, 3 against the current motion. Now, what we don't know
is who,
is not just who, against what. So we know that the majority voted in favour of retaining the board's position at 3.85%. Did those 3 vote for cuts, or did those 3 vote for something else? And that's the other thing that I think will come about this. But that is going to catch a lot of people and the market off guard. But we did speak about this in the 20 minutes lead up, is it was going to be off brand. It was going to be off the communication around what they had said, that basically they need all of the data and the data conservative viewpoint to align with where they're at. Again, what I now want to talk about, because this is thrown us slightly, is that we were talking off air before we came on about what the banks are actually seeing from us, from you guys out there watching and doing, is that outside of those that do it automatically and independently of you as mortgage holders, if you listen to it, you know, CBA, NAB, ANZ, etc., have been telling us that only 1 in 10 have actually called up the banks and moved their repayments to the minimum monthly repayment, which suggests that either 2 things: 1, we're lazy, possibly, but I would take the other option, which is we are trying to therefore take more money off the table from the actual loan debt that we have with the lower interest repayments. The other thing to talk about that we didn't get to talk about before, and that might be also into this, is there is growing suggestions that the cost of living crisis is over. And that maybe if we start reading really, really line by line into that, is that pressure, that 50 basis points, the fact that people are banking it, savings ratios are starting to move up, which is what they're talking about in the statement on screen, that we are getting to a point where the crisis, and I would argue this, it's still there, the pressure is lower. I mean, prices haven't declined, as Ben read out before. They're just not growing at the same rate. We have disinflation, inflation, but not at the same level it was this time last year. We don't have deflation. And so for me, all of that put together is sort of what we're reading on screen, which is that, and I can see it's all written over your face, and I agree with you, it's confusing.
Okay, so I get my quarterly inflation data come end of July, right? So, and let's say it's confirmed that it's still within the band, right?
Trim means
so which is currently where it is. Look, the only thing I can think of is they're trying to do something else. I'm trying to work out what it is. Like, obviously, full employment or strong employment is still there, but I'm also interested in terms of, are they concerned about the housing market? Because obviously this will put a little bit of a pause in the housing market, because we could have been off to the races, right?
Maybe take that first line there of maintaining price stability and full employment. So the board continues to judge that the risks to inflation have become more balanced and the labour market remains strong. So this is probably that inflection point, is that inflation is now at a level that they're more comfortable with, but they are therefore still very aware that there is strong employment.
Yes.
And therefore are cautious about the outlook around, possible increases in aggregate demand.
But there is also lag data,
Yeah.
and ultimately
I'm with you on
takes
this.
6 to 9 months for it actually to flow through. This, if it was 25 basis points,
But so, and on that point, and you're bang on, I'm with you on this. Technically, the February rate cut is only just taking effect
correct
now.
And so are they worried that they were going to supercharge or get a spike in inflation? I mean, I suppose the tariff story is something.
It's there.
Uncertainty in the world economy remains elevated. Okay, whilst the final scope of US tariffs and policy responses in other countries remain unknown, financial market prices have rebounded. The equity markets have definitely been performing,
but again,
incredibly strongly.
The reason they've performed is because the Liberation Day tariffs were paused for 90 days.
Yeah,
and so
policy.
If you look at the April 8th prior low to where we are now, US markets are up 25% after falling 16.5%.
So are they pumping the brakes? Are they thinking that we were potentially going to be off to the races?
So maybe. I mean, again, the future intentions and the consumer confidence data, which we'll get to in a minute once we get over this dumbfounding decision, is that we have a scenario where confidence 12 months in advance is actually on the way up, right? So time to buy a house is getting slightly higher. Price expectations around housing was going to the highest level that we'd probably ever seen.
I can't wait for her.
330 now is going to be incredible.
It's going to be an interesting...
We need to actually get through this so that we can get off and actually listen to her, because she is going to have some serious, well, at least I hope the journalists ask, some serious questions about how 6 of the members today voted to hold the cash rate for an extra 5 weeks, because that's what we're now saying, right?
Yeah.
Right. August becomes a near lock. Is that what it is? But today was a near lock. So the data.
Why surprise the markets? What do I benefit from?
Yeah,
the only thing I can think of.
I need to look at the markets while we do this.
The only thing that I can think of is that she was worried about basically setting inflation expectations at a higher level rather than killing the inflation beast. So she potentially, and the board potentially want to make sure.
So just to sort of point it out, like what it's done is it's caused the dollar to rip higher by 0.5%.
Bang!
Like that's incredible. So it's now trading at got to as high as 65.5 after trading at 65 on the nose at the number. You then also look at what's going on in the equity market. The ASX has fallen, as I speak, over 30 points. It was up. Now it's actually down. So it was up over 15.5 points. It's now down 16 points since that. So that is...
the credibility now. This is probably...
Well, so this is the question, right, that we're asking. Yeah. Was this the credibility that they were talking about, which was the data dependency isn't clear enough for us to do that? Everybody got excited over the monthly figures and away we went.
But it contradicts the minutes of the last meeting, which is a 25 and only a 25 and a 50 basis points cut was considered at that meeting.
Yep.
And here we are thinking that, we've slayed the inflation beast, but there's still more to be done there. And so it's really clear in terms of looking forward that the RBA are very mindful of a tight labour market. Mm-hmm. They're very mindful of potentially the risk of wages growth getting beyond where they want it to be in terms of, and that bakes in the risk of higher inflation for longer. So there's upside risk in that. The weak productivity, I hope Michelle Bullock comes out and I hope she says this has all got to do with productivity. In terms of, I want her to say that we need to fix productivity. If you fix productivity, then I know inflation is completely then done, and then we can be off to the races in terms of bringing the cash rate lower. So hopefully she talks all about the lack of productivity that we're currently getting, because wages have gone up, but we're producing less or about the same as what we were producing before COVID. So that is obviously something we have talked about on this update as well in terms of that. So we have been surprised by this decision in terms of that. And I think obviously the US tariffs rollout is still an unknown in terms of what that looks like. So
Let's go through.
We'll be data informed, but let's basically just get through some of this data.
A lot of what we're about to talk about comes into what we're just talking about.
Supports what we're basically saying. So let's have a look at the employment and participation rate, or the unemployment as part of that story. So the ABS released their seasonally adjusted unemployment rates, which held steady at 4.1% in May, unchanged from the previous 2 months and in line with market expectations. The number of unemployed people declined by 2,600 to 618,300 people, with those seeking full-time jobs falling 16,100 to 415,200, while those looking for part-time jobs increased by 13,500 to 203,000. Meanwhile, employment unexpectedly fell by 2,500 jobs to 14.62 million, missing forecasts of around 25,000 increase after the downwardly revised 87,600 rise in April. Part-time employment declined by 41,100 to 4.52 million, while full-time employment increased by 38,700 to a fresh record high of 10.1 million. The participation rate edged down to a reading of 67% from April's 3-month high of 67.1 and below forecast of a 67.1 reading. The underemployment rate inched down to 5.9% from 6%. Finally, monthly hours worked in all jobs increased by 25 million to 1.994 million hours worked.
So I think what we also need to point out at the moment is that the employment data is really messy.
Well, let's build on that.
Yeah.
Let's build on that with the ANZ Indeed job ads data. And we can see here from ANZ and Indeed that the job ads declined by 1.2% month over month in May. This is the latest data we've got our hands on, making it the second straight month of drops and quickening the downwardly revised 0.3% fall in previous months. Now, and it was quoted as, although the job ad series has remained in a tight range of 114 to 117 over the last year, the May result is in the bottom end of the range and marks the slowest level of job ads since March of 2021, which was reported or said by ANZ economist Aaron Luke. He added that the labour market remains tight whilst robust employment growth and a low unemployment rate. Meanwhile, and we go around the states, Queensland has been the biggest drag on job creation this year, offsetting gains in other parts of Australia, according to the Indeed senior economist Callum Pickering. The report also highlighted steady increases in jobs postings within education software development throughout May. Year-on-year job ads were down 5.7%, but remained 13.66% above pre-pandemic levels. It's still showing job ads down. Like, that's taking the pressure off. I find this result quite interesting.
If you look at what's going on inside the ABS data, it's moving all around with participation rate, full-time and part-time.
Mm-hmm.
And then what's not fully reported in it is not just primary employment, but secondary and third.
Yep.
So what we know from a lot of the breakout data and a lot of the surveys that players like ANZ and Indeed do is that the amount of us that actually have a second
multiple or gig economy jobs,
gig economy, side hustles, etc., is slightly starting to change.
Yeah.
We're also seeing more and more that the dual income family is, we know it's the future anyway, but it's at the highest level. It's basically been on record, because what's not in that participation data is that female participation hit another record.
Yeah.
And so overall, there's more of us in work, but it's where we're working. And again, the Indeed data shows that we already knew this, that aged care, education, health, they're the three largest employers of the last 20 months.
Yeah.
And the majority of that is funded by public sector. We know that 80% of growth over the last 12 months has been private sector, and why the government is now starting to talk about productivity commission and this productivity roundtable.
Yes.
Because all of this, if you actually start stripping it out and get a bit more granular, private side is really slow. Public is too high, and we have a problem about the growth of that, which brings us probably to the next chart.
Because it's the care economy, right? That's also there. But here's what we're seeing in public sentiment.
Yeah.
You know, so we saw the July numbers from the Westpac Melbourne Institute consumer confidence area. So the numbers that matter, we're seeing obviously a spike in June. So that's a 0.5 of 1% increase, and it's improved by 10.8 over the course of the year. In terms of time to buy a dwelling, we're also seeing that also increase by 3.6, and the increase over the year has moved 28 basis points. And we're seeing that in terms of evidence on the ground, the number of people turning up, the number of competition we have in terms of bidding, pretty much around Australia at all the places that we're currently buying. And then, of course, what we've always talked about is this incredible number of the expectations that Australians have that house prices just go up, and they just keep going up, and they're always going to go up. And you can see that reading there, that is an unsustainable reading. That's got to play into the psyche of the RBA.
Yeah.
Like that's speculative levels in terms of house prices always go up.
Yeah. And that's also, again, because the expectation, and we saw this start in October last year, the expectation of rate cuts was going to be a stimulant for housing.
Wealth effect.
Et cetera, et cetera.
Yep.
Because don't forget, 100 is the neutral point between optimism and pessimism.
Yes.
So we are still technically pessimistic on the consumer side. But the one thing that I can't get over that is still quite fascinating, getting back to what we just talked about with employment, the expectation of losing your job, it just isn't there.
No.
Right. So the unemployment expectation index is the one that always fascinates me, is that it remains really optimistic. We remain quite optimistic about jobs and job employment.
Yeah.
The possibility of holding a job or finding a job is what the survey looks for, is still, I mean, as you can see, it's near enough to trend, right? So it's near enough to the 128.9. All of that taken together shows you very clearly that we're getting a little bit out there, and that maybe, as you said, gives the RBA that extra 5 weeks just to see. I mean, the second part that we didn't highlight there is time to buy a major household item. That's now optimistic.
Yeah,
right.
It's moved into optimism territory.
That's a big change if you look at it year on year. That's a 25% increase, when this time last year was peak of
fascinating, isn't it?
Right. So there are so many different ways to look at this, and what the RBA has done today, you know, Ben and I, you can tell by us, is sort of going, okay, what are they seeing? What are they reading in the data that has led them to say we need to just wait a little bit longer? And they, you know, something we've learned in the post sort of cost of living crisis, let's call it that now.
Yep.
Inflation psychology, right? This is the other thing that I think is probably still there, is that, are they worried about stoking? Are they worried about being caught behind with what happened during the end of 21 to 22, that employment is still there, expectations of keeping a job is still there, the expectation about price increases in housing is through the roof, and therefore the time to buy a dwelling, although it's still slightly pessimistic, it's 28% increase from this time last year. That needs to also be all part of it. Can that be the draw line? Maybe.
So here's a question, right? There's definitely a cohort of people who have been doing it tough, right? And there has been absolutely, your money doesn't stretch as far. So there is that cohort. But has that cohort been overly represented in media stories over the last 12 to 18 months because of sales papers, fear sells? But
that would also suggest that the investment bank research and all of the retail banking research is also off the mark.
Well, yeah, but it does change sentiment. Like it does change. Like, in other words, if everyone else is doing it tougher, then I need to probably maybe pull my head in. The same way in which the wealth works in the other direction. And we have been seeing some economists and some banks being talking about that. It does feel like the sort of housing crisis and the spending, or the sort of affordability crisis that we've been going through is something that has left some of our psyche. And so maybe this is their way of effectively saying, well, we do want people to still keep their money in their wallets just for a little bit longer, to basically make sure that we do bake in that we don't want to have an upward cycle inflation too quickly. So we're going to take and hedge our bets in that story.
Yeah, I know you're trying to make sort of good positive sense of what's just happened, but we spoke about before. I mean, I agree with what you just said, and that's a fairly reasonable point. Counter, obviously, is what we spoke at the start, is that business insolvencies are already at records.
Correct. This will not come as good news for business, especially small business operators.
And we've just seen signs that retail spending and consumer spending, which is obviously what you just put on screen, was moving up. But as you can see from this chart, it's not moving up at a level that we saw that drove things to mental prices through 23 and 24.
No, so let's take a look at basically consumer spending data. We saw the ABS report that housing spending in Australia climbed by 0.9 month on month in May, rebounding from a marginally revised flat reading in April, marking the fastest pace of growth since October of 2024. The pickup was supported by the May rate cut, which helped boost spending activity. So maybe they're just a bit worried here in this. Okay, expenditure bounced back for clothing and footwear, 3.7 versus negative 3.5, transport 1.7 versus negative 1, and furnishings 0.6 versus negative 0.5. Moreover, spending on miscellaneous goods and services accelerated 1.3% versus 0.1 of 1%, whilst outlays continued to rise for health, 1.1 versus 1.7, recreation 0.5 versus 0.8, hotels, cafes, restaurants 0.8 versus 2.3. On an annualized basis, personal expenditure increased by 4.2%, the strongest yearly growth in 5 months. So maybe again there is, and we know, in talking to and speaking with some of the sort of experts in this area, the older baby boomer generation, they have not experienced, they've got access to their super, they're out there living a great time, and that's.
They might not tell you that. So this gets back to what you were saying before.
Well, the ones we get reported on, because the journalists are looking for the ones that are doing it tough, and they want to report on those. But it does feel like there is a larger cohort that is actually going okay.
But if you listen to baby boomers in general, because of the life that they've gone through, the late 60s, 70s, 80s, and we've talked about this before, they are genuinely conservative. And they also don't see value, I think is the correct term for certain amounts of spending. So they're certainly there. I don't think it's all that simple either. And again, while we're sitting here, I'm trying to find as much more information as I can about what they're doing. And again, most of them are saying this. This is the thing. Most of it is saying, they've got time. I'm like, to do what?
Yeah, like if it's going to happen, why not do it today?
Every single different one I'm looking at, of all of the sort of the feeds that I normally do before I come on and talk to you, they're all saying, the ones that were hawkish, they're all saying, well, just gives them more time. Time for what?
Yes, like time for the inevitable.
Yeah.
Anyway.
And to get they all saying this confirmation. I'm like, confirmation's too late.
Yeah, well, it's lag data anyway. Here's the business confidence and conditions survey from NAB. Right, this one is the one we were talking about in terms of how business is feeling, how private investment is feeling in the current market. The NAB Business Confidence Index rose to 2 in May from a -1 in April, turning positive for the first time since January and marking the highest level in 4 months. Sentiment strengthened in most sectors except manufacturing, mining, and wholesale. However, business condition eased. So confidence in thinking that the cash rate's going to move down has changed that positive sentiment, but condition eased again to 0 versus 2 in April. So it's coming back, reflecting a steady fall since late 2024. Here's the sub-indexes. Employment deteriorated 0 versus 4. Profitability stayed negative at -4. These businesses are struggling. And sales slowed 5 versus 4, with retail forward orders edging up, but this is -2 versus -3. Capital expenditure, did surge 6 versus 1, and capacity utilization was higher at 82.3% versus 81.4. Purchase cost growth moderated at 1.1 versus 1.7, whilst labour costs gained slightly 1.7 versus 1.6. Product price growth fell to 0.5 of 1%, with retail price growth steady at 1.2. NAB's chief economist, Sally Ould, said business conditions remain weak. If these conditions in the coming months continue, it will be difficult for confidence to rise from current levels. So it's
just snapshot that.
It's baking in this problem that we've got that we need to kickstart.
Sally Ould was one of those forecasting 3 rate cuts in 2025.
Yep.
So take that as you will. But she's dead right. I mean, that's the thing to remind yourself here, is that this is what she does. This is her bread and butter. This is NAB's biggest input is business banking. And they know this better than anyone out there to say conditions are weak. And I would argue that that little blue tick that you can see on the right of the screen, the next time that we present this to you, will be back in yellow, because today will have changed that. It will hurt.
Yeah.
Because not only that, it again, what we're talking about is future intentions. We're going to come to the US in a minute and about what's happened with, the outlooks. Whether you agree with Trump or not doesn't matter. The tariff uncertainty is creating all sorts of volatility. The RBA now creating a slight uncertainty about maybe they're not going to do what we think they're going to do, is going to change the outlook, and it's going to change that. And I'd almost put my money on the table saying that tick will go yellow for the next time you and I talk.
Well, I think also, I mean, if there is a silver lining, and, I don't like property speculation. I don't like it when the market gets ahead of itself. It's not good for anyone. But so let's have a look at some of the property data here. We can see this is the home lending data around the country. We can see usually what the indications are. If there's lots of activity, that's usually putting pressure on prices. And so we can see the WA markets, we can see the Queensland market very strong, and we can see the New South Wales flat. Victoria was actually coming down. South Australia has also been a strong market, and you can see, and Tassie's starting to have some life bred back into it. So it just reminds us that, that maybe the silver lining here is that there's a little bit more time before things get a bit hectic in the property market. So if you're currently looking, maybe there's not 5 competing buyers with you at the moment. Maybe it's just 2 or 3 that you're going to have out there.
Particularly after today.
That's my point. I mean, if there is a silver lining off the back of that, maybe you've just bought yourself a little bit of less competition at Saturday's auction.
Yeah.
In terms of the one we got here, the building approvals, this was obviously the 2.1 million target that we'd set in terms of trying to build a number of new houses by a certain time. We are miles off the target. Again,
what's fascinating by that whole thing, it was never even there.
No.
Right? I mean, that's what that shows you. That
it was an aspirational target.
But it's not even an aspirational target. It was. I remember when it came out, I remember sitting there going, we've never done that.
No. We've never
done that.
Even when we had the Asian building boom here, where all of the Asians were coming and buying our off-the-plan apartments, our building boom that happened was off the back of basically record levels of apartments being built in Melbourne and Sydney.
2018 was the record. I think it was 265,000
new builds. Yeah.
And we needed to basically do that from day dot, and we were never going to get there. And so what Ben's highlighting here is that, again, simple economics, the supply and demand side of the housing market is still, in my view, the fundamental driver of everything going on. And at the moment, all drivers are on the demand side, not on the supply side.
Correct. So here we are with quarterly growth rates pretty much across the board. The monthly ones fluctuate up a little bit and down, but you can see there your strongest markets still remain Perth and also Brisbane, with the outlier, unbelievable Darwin, shooting the lights out at almost a 5% growth. And then you can see the 1.5. Darwin is a hot market. Just go and have a look. There's about 150 odd properties available for sale in Darwin, and about 95% of them are under offer. So it just gives you a bit of an idea in terms of, and that's, you got to remember, Darwin's been dormant since the early 2010s. So that market is playing catch up, and yields and all of the opportunity up there is going to be pocketed by those people getting into that particular market. Now, let's wrap up the Australian market. And here, likely more rate cuts to come. That was what I wrote prior to obviously coming live here. We were going to be talking about what is the neutral rate, how many more are we going to basically see. The only thing we can say here is rate cuts are coming.
They have to be.
They have to be. There's no logical reason why we won't be seeing a rate cut anytime soon, unless we see a black swan event. Is that now? The other debate we were going to have here was, what are the banks going to likely do in terms of passing on that rate cut? Well, the reality from our point of view is we do think at some point in this cutting cycle that the banks will take some net interest margin back. They need to, with the pricing wars that they had during the very tough competitive market during high interest rate times. So they'll grab back a little bit of net interest margin as part of that. And as we've sort of wrapped up here, property prices are still on an upward trajectory. I don't think this is going to pull the wind out of the sails, but it's certainly not going to be, that northerly breeze that might have kicked things along a little bit faster. And so whether that's part of the broader thinking of the RBA in terms of managing the reacceleration of the economy. We won't know unless Michelle Bullock tells us.
Which is why we've got half an hour to do this, because I got to listen to what she wants to say about this. So let's do it.
So here we are. Now we're off over to the global economy now. And like we always do, we'll start with the biggest economy on the planet, which is the US. And we built this little theme at the start of the year around what we call the Trump experiment. So a quick update on the Trump experiments. Well, we've got the big, beautiful bill. The big, beautiful bill from the Trump administration is going to pass.
It's passed.
But most parts of the, I think the final ratification.
I think he's done.
Is done. Is it? Well, I thought it was.
maybe the big crayon is out this Thursday.
Yeah. Now there's $5 trillion worth of additional spending baked into the forward estimates, and there is a massive debate going on in America right now between the likes of Elon Musk and other commentators that I listen to about, Ray Dalio. Just some really powerful people who understand that the level of debt,
mental is
$33 trillion worth of overall debt that they've got. So they need to, I don't know, the only way you can pay off debt is higher taxes, or you can basically grow the economic pie at a significant clip of the ticket. And, in this particular case, they're also giving tax cuts that's baked into that spending.
And with that middle one, even for the US, which has done this before, the clip that you're talking about is it's developing nation levels, not developed nations. And it's just
that's $5,000 billion of additional spending. So obviously the pressure's
what was
on.
already there, which they complained about leading into the last election. And
Jerome Powell has got his work cut out. He's getting a lot of pressure in terms of adjusting monetary policy to try and line up with the fiscal policy. He's lost his job. There's no doubt about that. Hopefully he'll serve out his time, and hopefully he'll hold true to his principles and won't be pressured and just getting on with the job. And of course, even today we got Japan, Korea. Last week we got Vietnam, we got Malaysia in terms of the take 2 tariffs. I don't think the Australian one's hit yet. Might hit overnight.
No, but it's
at the
more
time
about
of recording. It's
I'm
not
glad
out.
you raised those. So we forget. We always talk about China. We know China is our largest trading partner, but number 2 is Japan.
Yep.
Number 3 is South Korea. Number 5 is India.
Is India.
Right. And in the top 10, you've got Thailand, Malaysia as well.
So we've potentially got some upside out of turning all those goods back to Australia.
There's indirect and positives and negatives to what's happening. So the indirect is, Japan and South Korea slow down the demand for our exports, things like iron ore, things like coal, things like gas.
Yep.
But as Ben just pointed out, the productivity can correctly pointed
turning the apples into apple pie, and what we get back here, we potentially could get some cheaper goods.
Because this, again, a reason I wanted to show this chart, which I think is fascinating around it, is where exactly tariffs will probably end up. So clearly they're not going to be what they were for the post-Liberation Day high, which is that one you can see with the red dot at the top over on the right-hand side, that top there. The current one is where we're at, because don't forget, at the moment, we're on a pause. The 1st of August is now the date, considering that we've had these handout of these 12 letters and what have you. But the current level is there. The reason it's higher, don't forget, should we use the Americanized term? The seasonal, the sectorial tariffs, steel, aluminium, auto manufacturers, particularly out of Europe, Canada, and Mexico.
Effectively heavy industry.
Yeah, which is why the current level isn't actually back to the blue line, because there is tariffs that are in place.
Yeah. So
the question mark is where it would end up. And you can see the other one there is that if the trade court holds up. So don't forget,
WTO.
Don't forget, they are being done by state courts.
Yes.
Which the Supreme Court is probably likely to overrule, considering how heavily politicized that is.
Yep.
And then, yes, the World
Trade Organization.
Let's also be honest about that
breaching, fair trade agreements.
Trump couldn't care less
about
that one. So I think what needs to be made out is that the question mark level is probably where it will be. So we will see that the overall tariff duties collected in the US, the expectation is that it will be 21% total. At the start of this, it was expected the average would be 27. So it is less, but it's still significantly higher than we have probably seen in over a century.
Yep. So excuse me, let's have a look at the US Bureau of Economic Analysis and see that this data was released on the 26th of June. And so we're looking at the GDP numbers here. And no surprise here, when you have an economic shock like that, people don't spend and you have an economic outcome like we've just seen. So the US economy contracted at an annualized rate of 0.5 of 1% in Q1, the sharpest decline than the second estimate of a drop of 0.2 for the first quarterly contraction in the last 3 years. The weaker GDP figure was largely driven by significant downward revisions to consumer spending and exports. Consumer spending rose just 0.5 of 1%, the slowest pace since the sharp declines of 2020, which was obviously the COVID period, down from 2.1% in the previous estimates. Exports grew by only 0.4 compared to the early estimates of 2.4. These declines were only partially offset by the downward revision to imports, 37.9 versus 42.6. Remembering that in line with the tariffs coming, all of these forward orders and getting all of that stuff arriving before the tariffs kicked in was the agenda of all of those exporters into the USA. The sharp rise in imports reflected the rush of business and consumers to stockpile goods ahead of the anticipated price increases stemming from the series of tariff announcements. Meanwhile, federal government spending dropped 4.6%, the steepest decline since Q1 2022, and in line with the second estimates. Fixed investments rose 7.6%, the strongest gain since mid-2023, but slightly less than the 7.8 in earlier readings. So we did see, obviously, DOGE, the Department of Government Efficiency, has had an impact in terms of some of that spending, but this big, beautiful bill that they keep talking about is going to ratchet that up. There are some health savings. There's some less spending in health in there, but everything else is pretty much spend.
Yeah, so that is Q1. That's when tariffs were, the peak of the agenda. Expectations were all over the shop.
Equity markets were falling.
Yeah, so it will be interesting to see what April through June did in the US, because I think there will be
equity markets are up, wealth effect on top of that, spending conditions
and
seem
then
to be
again,
a bit better.
also
Employment,
because the pause was there, right? So that brings us to this, which is what's going on around the inflation figures and where we currently sit on inflation in the US, which is that it's sort of flatlining.
Yeah, well, and that surprises us, but I don't think we're seeing the lag data of the tariffs coming through just yet. So the annual inflation rate
don't exist yet.
Well, that's true. Only those ones in those secular, sectorial markets. The annual inflation rate in the US rose for the first time in 4 months to 2.4% in May from April's 2.3%, the lowest since 2021, but came in below expectations of 2.5%. Prices rose for food, transportation, used cars, trucks, and new vehicles. On the other hand, inflation fell slightly for shelter. Meanwhile, energy cost declines also were falling from their April falls as well. Then you saw prices for gasoline and fuel oil continue to decrease, while the rise in natural gas prices remained elevated. On a monthly basis, the CPI edged up 0.1 of 1%, below the 0.2 in previous month and the forecast 0.2. In addition, annual core inflation, which excludes those volatile items that we talked about, remained at 2.8%, holding its 2021 lows, whilst expectations were pointing to a rise of 2.9%. The monthly core CPI also edged up by 0.1 of 1%, below the 0.2 in April and expectations of 0.3. So it's surprised on the downside, but again, I suspect that it had a bit to do with
before we go on that chart, the other thing you've got to remember that's the difference with the US with us, they need it to be at 2%.
Yes.
So the thing
that's their target.
That's their target. So what needs to be made out before we come to, because I know what we're going to talk about next, which is the federal funds rate.
Yep.
They've never reached it. So this is the thing that's so fascinating.
It's aspirational.
But they need it there. They do. So that bring it to the next chart, and that's the federal funds rate. This is the target. So this is the mid of the band, because it's actually a spread of about 7 or 8 different products. But they haven't moved at all in 2025.
No.
Ben spoke before about the political pressure coming on the board. The board is very split in this, and it needs to be made out very clearly that the board would like to have a dovish bias, but they can't. And it gets down to, again, they haven't achieved the 2%. They now have an issue where they are possibly facing a technical recession because they've had a negative quarter of growth.
Yeah.
So they need to think about cutting rates. But inflation is this big, dark unknown because what you listen to the minutes, particularly the Fed minutes, they're all arguing the same thing, which is tariffs will have some form of inflationary effect. It just will. The question they don't know is when.
Yeah. And like we know that, you know, even when we introduced our goods and services tax, we had a one-off spike, and then, you know, basically inflation is then measured off that change. Now, the argument I think those people who are pro-tariffs are making is, yes, there will be a one-off event, but then with the cheaper taxes that we're getting, it won't feel as bad in terms of where our spending power will be, et cetera, et cetera. And ultimately, it'll bring more revenue in for our country, and that'll help us retire the debt. That's the big dream in terms of the, you know, what they're trying to execute on from economic and government policy. So let's have a look at the Fed Reserve. Left the Fed's fund rate unchanged at 5.25 to 5.5 for the fourth consecutive meeting in June, in line with those expectations as policymakers take a cautionary stance to fully elevate the economic impact of President Trump's policies, particularly those relating to the tariffs, immigration, and taxation reforms. Officials also noted the uncertainty about the economic outlook has diminished, but remains elevated. So this big shock and the impact of that, it hasn't quite materialized. Despite this, the Fed continues to project 2 rate cuts later this year, though it's anticipated only 1/4% point in 2026-2027. In its update projected, the Fed downgraded its GDP forecast for 2025 to only 1.4 versus 1.7. Now, remember, they're chasing 3%. 3% GDP growth in a massive economy is hard to do. And then only 1.6 in 2026, whilst leaving the 2027 estimates unchanged at 1.8. So they're only halfway of where they want to supercharge their economy.
That's a double.
It's a double. They've got to double the growth rate. And of course, you know, they've worked out that they don't have the energy to run the AI program. They've got massive problems. They don't have the infrastructure. Now, the next meeting is on the 30th of July. And, you know, that's where Jerome Powell at a recent update did say that a cut is in play, but it will be informed by the data.
And just be aware that September is likely when he has his predecessor announced, and he's going to sit as, you know, a lame duck for the next 18 months.
It is 18 months. There you go. So it's crazy.
It's crazy.
Now, whether he stays on, because that would be interesting, or whether he gets pushed.
I think he will.
Yeah, I hope he does, because I think it just balances out what's going on over there.
But it's also, it'd be unprecedented for the president to push out the governor of the Federal Reserve.
Well, if the governor doesn't do, I mean, so much for independence. Yeah, I totally agree. Okay, let's have a look at the employment data, and you can see it there. Still, you know, obviously we're swept through 2024 into 25. So we've seen some movement, as you can see on the graph in front of you. The US unemployment rate edged down to 4.1% in June from 4.2% in May, defying market expectations of a rise to 4.3%. The rate held, the rate has held within the narrow 4 to 4.2 band since May of 2024, signaling broader labour market stability. The number of employed dropped by 222,000 to 7.015 million, whilst employment rose modest by 93,000 to 163.366 million. However, the overall labour market shrank by 130,000 to 170.38 million. The labour force participation rate slipped by 0.1 percentage point to 62.3, its lowest since December of 2022. And the employment population ratio held steady at 59.7%, the weakest reading since January of 2022. Meanwhile, the broader U6 unemployment rate, which includes discouraged workers and those employed part-time for economic reasons, fell slightly to 7.7% from 7.8% in May. So I think what we're going to see is this is going to be watched heavily over the course of the next 3 to 6 months.
Just to give you what the U6 is in Australian terms, that's underutilization.
Yeah.
and what that is. So that's those that are in part-time,
One work, can't find enough work.
And those that are unemployed.
Yeah.
The other thing about this, as Ben just pointed out, the participation rate is the one to really hit home here.
Yeah.
It is masking the fact that unemployment in the US is on the way up.
Absolutely.
Because if the participation rate's falling, they actually fall out of the survey. So they're unemployed, but are actually not captured by the data. And that is why it's probably more likely that the unemployment rate in the US is in the high 4s, maybe even touching 5, rather than what it currently tells you.
Yeah, I think there's a really good message to take away there. Look, the last chart that we have on the US is this one here, which is the consumer confidence and sentiment. So we can see here that the University of Michigan Consumer Sentiment Index for the US was revised higher to a reading of 60.9 in June from a preliminary reading of 60.5 compared to 52.2 in May. Consumer sentiment rose for the first time in 6 months, led by a broad-based improvement across numerous facets of the economy, with expectations for personal finance and business conditions climbing about 20% or more. The current condition index was revised sharply higher to 64.8 from a preliminary 63.7 and above the 58.9 in May. However, sentiment remains about 18% below the December 2024 as consumers views are still broadly consistent with an economic slowdown and an increase in inflation to come. Here's the story. This is, obviously we saw positivity out of Trump getting elected from his base. And remember, he won the popular vote as well over in the US. There is still a lot of positive sentiment out of a lot of what he's doing over there for his base, and his approval rating is still sitting quite high. So if
for his base,
for
the
his
approval
base,
rating overall is poor.
No, it's still actually sitting pretty reasonable. It surprised me in terms of there's obviously still a lot of people more broadly that are still happy with what's going on over there. Now, here's the deal. You've got to get that sentiment and that narrative and that story out there. If they can convince America that they're going to be better off and spending and doing all the things, because this is not what this sentiment survey is showing. This sentiment survey is what's going to happen to me. So there is a economic narrative that they're trying to sell, and they're trying to pitch this story over there. Now, if it pitches better than we expect it to, then the conditions won't be as drastic as what will play out. But our view, and most people from around the world and most economists' view, is that narrative won't play out. But remember, economics is a study of what humans actually do, and we measure those movements and businesses and so forth. So if he can pitch this story and the bulk of Americans, or at least half of them, buy into it and continue to keep thinking about that, it may not be as bad as what is playing out. And that's what we're seeing in the data. We're seeing a little bit of this. Actually, it hasn't. Now, tariffs are coming again. So we see what happens there, and we see whether he fine tunes or he walks back from those positions. All of those things are still true. So let's wrap up the US by saying tariffs is the biggest news over there, followed by what that's going to happen in terms of inflation, which will feed into the interest rate story and that economic growth. But if he can influence the monetary policy and the Fed board to lower interest rates when technically they shouldn't be, if inflation is actually on the upswing, that's a big story here, right? Yep. In terms of being able to manipulate the market, which is exactly 101 Trump fashion.
Yeah.
All right, let's move on to China now. A couple of slides on the Chinese market that we just want to cover off on, because really, in terms of the story out of China, it is just one of what happens with the US. So we'll get to that in a minute. Let's have a quick look at their inflation data. You can see it's effectively anemic, is best described. So consumer price index in China decreased by 0.2% in May from the overall previous month. On a year-to-year basis, China's consumer price dropped by 0.1 year-on-year in May, matching the declines seen in the previous 2 months and slightly outperforming expectations of a 0.1% decrease. So look, that's what we're looking at here. There's really no inflationary challenges in China. Off the back of that, then what we have seen is the cash rate. So the cash rate here, we see the People's Bank of China kept their lending rates at record lows during their June fixing, in line with market expectations. So no real change here. The move comes after the central bank reduced borrowing costs by 10 basis points last month to help cushion the economy from the impacts of the new US tariffs, and was followed by recent deposit rate cuts by major state-owned banks. So really nothing to see here as well,
Nope.
just yet. And so what we're talking about here is it's much of the same as what we've reported on in the last update. And that's US trade deal is a significant deal for them in terms of the short-term economy.
Deal breaker, I think, is the way to add on.
Yes, that's right.
At the moment, China is, I agree with you, it's a wait and see scenario for them. And they have shown previously that they're probably likely to fight a bit. They'll put up some pressure on the administration. So I'm waiting, because their Liberation Day tariffs were different 90 days. It's into mid-August. I think the middle of August is going to be really fascinating when Trump actually says this is what it is, which will probably be 30% minimum. The response we've already seen it previously when they ratcheted it up and it went to 145%, and then it went back down to zero. We all just took the gloves off for a second, just had a bit of a rest. So I agree with you. We're in this wait and see to find out what Washington will say before Beijing retaliates.
This is the biggest economic game in town, bar none. It dwarfs basically everything else going on around the planet right now. And China are definitely playing a hard game with their rare earths and their magnets. And that has left the US surprised in terms of some of their essential and big industry. These magnets are pretty much in everything from phones to electronic. And so China has realized that they've got a 2 or a 3 year advantage because they supply over 90% of these rare earth magnets and the treatments that happen in terms of making these magnets viable to use. So the US have been caught a bit off guard by that. They're also being caught off guard by their silicon development. Their silica is getting very, very strong on mainland China, not so much need from Taiwan. Their AI is surprising on the upside. And of course, I've mentioned this before, the amount of energy that is going to arrive, energy production, bringing a significant competitive advantage to effectively a net energy zero cost is going to be very, very strong for them in the longer term as they compete on the global stage. Let's now wrap up our global look at the Eurozone. We want to try and finish by 3:30 because we're keen to go and watch.
I have to listen to this.
The update. So here we are for the Eurozone. We did receive the quarterly data. It was released in early June. We saw the euro area economy expanded by 1.5% year on year for the first quarter, and that was 25% higher than the 1.2% in the previous estimates, and the strongest annual performance since Q2 of 2022. This follows a 1.2% rise in Q4 of 24. Gross fixed capital formations rebounded, and both exports and imports also rose faster. In contrast, smaller slowdowns were seen in households and government spending. Among the bloc's largest economies, we saw the German GDP stall, but expansions were recorded in France, Italy, Spain, and the Netherlands. When we then correlate that into the inflation story here, we saw the Euro Consumer Price Index rose slightly to a reading of 2% year on year in June, up from the May's 8-month low of 1.9 and in line with market expectations and also their targeted range. The figure aligns with ECB's official target. Among major economies, inflation in Germany unexpectedly declined, whilst in France and Spain saw modest increases and Italy's rate held steady. Services inflation, which is the one we always want to look at, accelerated to 3.3%, up from May's 3-year low of 3.2%, whilst the decline in energy prices softened to 2.7% from a reading of 3.6%. In contrast, inflation eased for non-energy industry goods and for food, alcohol, and tobacco, and core inflation, which excludes those energy and food prices we talked about, was unchanged at a reading of 2.3%, making it the lowest since January of 2022. What did that mean for interest rates? Well, we got an interest rate cut on the 5th of June from the ECB, delivered its 8th straight interest rate cut in its last meeting. Maybe the RBA needs to go and see what they're doing over there.
Well, what I wanted to talk about with that is that going back to this screen, if you have a look at the inflation read, right, and where the inflation is there,
paint that to ours.
Paint that to this with what's going on. Is that Yeah, we got a bit of an flick up when the ECB first started, because they did actually shoot the gun. They went a half, not just a quarter. They went a half. When they saw it wasn't moving with the first, because they did a quarter, and then they went, okay, bang, we need to really go. And they've been going ever since. It hasn't led to a stoking of inflation.
No, it hasn't.
And
a little bit of services inflation in there.
Yeah. So it's interesting. So let's come to the key takeaways, because it's true. GDP is improving. We need to point out, and I'm glad you put the equity markets in Europe are actually one of the best equity markets on the planet at the moment. And that's despite, all this stuff around auto tariffs and the threats of tariffs for the Eurozone as a whole. They are now changing their behavior. They're looking to other markets. They're looking to other opportunities. So instead of looking across the Atlantic and across the ditch, they're actually looking east, and they're looking into even as far east as us. And so the euro is an interesting one. It's going to have problems, right? It's an ancient part of the world. It does have, therefore, legacy economic constraints, but it's growing, and that needs to be clearly pointed out. That the ECB, I actually think, has possibly got it slightly right in the fact that they've looked through short term, and they're like, actually, no, we can see the data is going to be pretty flat, and we can get ahead of the curve. And if we do need to slow down or put the brake on a little bit, we can do that in the future, because Germany's not blowing away, but that's fairly standard. It's more, you look at France, you look at Italy, and particularly players like Belgium and Netherlands that are what they call the tier one peripheries. They are actually showing that they're growing, let's use the term as humming along at about 1 to 2% for Eurozones. That's really good, and that's what they want.
Yeah, and I think this, as much as the defence spending, which has been flagged as part of the NATO. So it's either 3% of GDP or 5%, I think, is what they want to move it to. It's around that number.
Whatever it is.
But that is certainly, from a debt point of view, one to watch. But
it's also your point on that is where they're looking. Right?
Well, they're going to have to invest in themselves, in their own R&D.
And they've made it clear that the US is not where they're going to go, because the US is doing this. So, Czech Republic is the one to highlight, is that Germany's change has said, actually, we're going to invest in drones, and instead of going to the US, which we would have gone to, next door to us, one of the best drone makers on the planet is the Czech Republic. And away you go. So
and here we are. So it is interesting, and I think that's something like, the decoupling from the US, from the rest of the world goes. Yes.
Czechia, I know you've changed your name. I do apologize. It's not the Czech Republic anymore.
Oh, Czechia, yeah. So, but I think there is a decoupling off the back of this. How do you treat your friends and your allies? And I know that the US is trying to, at the end of the day, it's all about, nationalism, is what we're seeing coming out of the Trump camp. So that's an agenda that he's set, and that's what he's been elected on. So he's going to try and live out that agenda. So let's wrap up in terms of our quick recap. For cash rate down in Oz. No, it wasn't.
No,
how many more cuts? So I'll take ownership of getting that wrong.
Same.
I definitely got that wrong. That we could probably say that there are more cuts to come, or there is
there will be rate
because in theory there's already been 2, so there will be more to come. Inflation, employment, productivity, key things that we're going to listen out in terms of going to watch the interview right now with Governor Bullock. In terms of upward pressure on prices will come, so it's very much a rising tide lifting all ships. All markets seem to be moving in that upward direction. US tariff negotiations still to play out on the global scene, and the geopolitical conflicts still cannot be overlooked in terms of what's going to be happening more broadly around those geopolitical issues. So I think that's a wrap for us. I need to obviously just say this video is general information, and obviously the opinions of ours, and sometimes we're wrong. In terms
case
of
in point
today, please, obviously, if you're looking for a professional investment advice, go and speak to a licensed professional for that. Thank you, everyone. Just remember, knowledge is empowering, but only if you act on it. And we'll see you again in August.
And let's go and see what Michelle Bullock has to say. See you in August, guys.
Bye for now.